everyone. Welcome to the Regulations and Policy panel. My name is Mira Ganor. I'm a law professor here at UT Law School, and I'll be moderating this panel. I also asked to talk a little bit about blockchain from my perspective. We're going to have a fantastic panel. We have Dave Hirsch from the SEC, the Securities and Exchange Commission. Dave is an enforcement attorney, and he is a member of the Distributed Ledger Technology Working Group and the Dark Web Working Group. And Alex Lakatos is a partner at Mayer & Brown. He co-leads the cryptocurrency COS and fraud group. In academia, we have a lot of excitement about blockchain and applications to blockchain. In particular, the focus is about smart contracts, those software that are self-executing. And traditionally, the traditional contract is problematic because we don't really rely on it. We have problem to engage in specific investments because of trust issues. And one solution that sort of mitigates this problem is the firm. So if we have a big enough firm and one unit of the firm transact with the other unit so they can rely on each other, but generally we cannot. So speculation is that smart contracts will solve this problem and may replace courts in resolving disputes and in interpretation of contracts, and also we will have a decrease in the size of firms. Other researchers are saying, well, there should be more speculation. There's really more speculative issue here. We should be more skeptic, because what are smart contracts? After all, this is just code, and this is a software created by humans, which means it's susceptible to bugs and fraud, and we still need to distinguish between execution and enforcement, and we still have a place for law in the enforcement part of it, even though we have self-executing smart contracts. So we have new technology, and the question is, do we need also new law? A few states have already enacted new laws. Delaware, for example, has this initiative. So Delaware is very important because the majority of publicly traded companies are incorporated under Delaware law. And as part of the initiative, the public archives should move to the blockchain. In addition, and even more importantly so, all corporate records are now allowed to be on a blockchain, including the stock ledger. So this is obviously very efficient, but it's more than just good bookkeeping. Because, for example, we have the recent Dole Foods case, that when Dole Foods went private a few years ago, there were security litigations, class action litigations by the shareholders, and about 3 years later, the Chancery Court came up saying, yes, shareholders, you're right, you should get more money, and the judge decided that every share should get a few more dollars per share. Except that when the lawyers were trying to distribute the money, they realized that they have about 33% more claims than there are actually issued shares. So blockchain can definitely deal with that. The problem is with the current way that brokers are recording those transactions, also because of short transactions, and blockchain is a good solution that Delaware is definitely happy to adopt. Arizona is another state that is working on laws that are incorporating blockchains. For example, it's already a law that if you have things on blockchain, that is enough to satisfy the legal requirements. On the other hand, there are states that put hurdles to the use of blockchain and blockchain applications. New York, for example, requires a bit license if you want to have a cryptocurrency exchange. The state of Washington has an interesting problem on its own. So there's a lot of mining activity in Washington. Why? Because on the one hand, they have the cool temperature there, which is good in chilling the servers that do all this crypto mining. On top of that, they also have hydro energy because of the Columbia River, so electricity is cheap. So that's a problem for the rural part of the state that attracts arguably too many minings. So they put a moratorium lately on the licensing, the business licensing, to actually mine cryptocurrencies in parts of the state. So these are new laws. We also have existing laws and regulations that potentially can apply to blockchain and blockchain application. It depends on how you actually classify the particular application. So for example, if we have a token or a coin, it might be classified as a security, and then the SEC will potentially govern the application, will oversee it, and the securities regulations and laws will apply it. Dave will talk more about that aspect. If we have a token which is actually more of a currency, a cryptocurrency, then FinCEN will intervene potentially to prevent money laundering. Alex will touch about that. Alex will also tell us about CFTC that views tokens as commodity. So they have authority to regulate commodities and commodity futures. The IRS actually looks at the coins and says, well, that is property. It's not a regular currency, so it's property. And if you exchange property, what happens? You might incur capital gains liability. Another interesting law that might have some implications for blockchain and blockchain apps is patent law. Now, when we started with blockchain and Bitcoin, they weren't patented. They were given for free to the public. And we have a lot of open source in this area, except that recently we see an increase in the number of filings for patent applications in the area of blockchain. And that is interesting because patents, of course, gives you an exclusionary right, a right to exclude other users. And very interestingly so, Bank of America, the financial institution that doesn't seem to support that much Bitcoin, has filed over 40 patents applications for blockchain-related innovation. Also, China has filed the majority of blockchain applications for patents. So with that, I'll pass over the floor first to Alex and then to Dave.
Thank you so much. Oh, happy Friday the 13th, everyone. Thank you for being here. Let me try to get to know you guys just a little bit. By a show of hands, how many people out here have ever used a smart contract, just themselves made use of one? Okay, I'm going to go with about 25% based on, I promise there'll be no math, there'll just be me making estimates, or as we say in statistics, the usual Puma numbers pulled out of my... how many of you are going to go home and work on a blockchain product? How many of you are actually developing something DLT right now that's actually more than have used smart contracts? I'm going to say about maybe a third of us in the audience. How many people are here to figure out how a blockchain product might work in their business in another sector, in energy and healthcare and something like that? Another maybe 25% of you. And how many people right now are thinking, I should be thinking about possibly doing an ICO? Don't be shy, there's no wrong answer. Okay, so that's some of us. Great, well thank you very much. What I want to do is I want to start by telling you guys a little story, and it's a story about a virus. It's the old-fashioned kind of virus. The time is November 2002, and in Guangdong province, China, we have a sudden spike in highly contagious, atypical pneumonia. And what does the Chinese government decide to do? The Chinese government decides, we shall keep this a secret. We shall tell our citizens what? Nothing. We shall tell the World Health Organization what? Lies about the number on the death count. And we shall do what when the World Health Organization wants to enter Guangdong province, China? We shall deny. We shall lie. We shall deny. We shall exclude. Anyone, what's wrong with this picture? China? Weapons of mass destruction? Yeah, all those things. I mean, I go with don't go it alone. Don't be an isolationist. What happens is March 2003, the world wakes up and realizes we're on the brink of a global health crisis. And what do? The World Health Organization decides that they're going to arrange for things to be collaborative, that 11 laboratories in 9 countries are going to have a virtual get-together, and they're all going to work together. They're going to be linked virtually, which was the thing at the time. And as a result of this collaboration, the other thing that the World Health Organization does is it takes a lesson from HIV, and it says, back at the HIV days, people didn't share work because they wanted credit publishing in the journals. They wanted to make sure they got patents. We're just going to run roughshod over that. We're going to start publishing stuff willy-nilly so that there's no possibility of those issues even coming up. And a result of this sort of intense spirit of collaboration, in a month, these folks had figured out that SARS, that the coronavirus was the source of this problem, SARS, and they had already begun to map the genome for the coronavirus. Compare that to AIDS, where it took 3 years to figure out that HIV was the cause because there wasn't this sort of radical collaboration. If 1 month versus 3 years is huge. I mean, if you think about it in the context that you're dealing with, if someone said, "We'll have your blockchain product ready to go in your ICU ready to go in a month," versus 3 years, and this is something much more important in the sense that people are dropping dead. Why do I start off by telling this story? I start off by telling the story to make the point of not going it alone. And this is, I think, a key thing in the blockchain space because of the importance that we're seeing of consortiums. Here's what Deloitte says. Distributed ledgers are business-to-business workflow tools, which entails that blockchain practically demands collaboration to set standards, develop infrastructure, and execute transactions. Deloitte further says, any company seeking to capitalize on blockchain's potential to increase operational efficiency and to enable new business models and client solutions should consider joining or forming a blockchain consortium. That is a pretty ringing endorsement for the idea of consortiums. And what we are seeing in this space, and we've talked about some of them today, and I just picked some at random. This is not an endorsement nor anything about these. These are just to pick some examples. We are now looking at over 40 different consortiums in the blockchain space, some of which are heavily funded. Some of them are focused on industries, financial services being one of the lead, then maybe cross-industry ones, and healthcare, energy, logistics, telecom are there. So that's what we're seeing. And what I'd like to do from a legal perspective, because we've helped a lot of consortiums or folks thinking of joining consortiums over the years, is talk a little bit about some lessons learned and some legal things just to be thinking about. These are things where you're going to have to ask your attorneys questions and do your own thinking and do a deep dive. But I want to sensitize, because if you're moving forward in this blockchain space, there's a decent chance you're going to be thinking about joining a consortium, thinking about forming a consortium, or not. And so I want to talk about some of the things. People are joining them why? They're joining them to learn and just sort of keep up with what's going on. They are thinking about them in terms of defensive positions. Let's know what the threats are. Let's know what's happening in my industry that could hurt me. And they're thinking of them affirmatively in how can I shape technology in a way that's going to be useful. And if you're an intermediary and you get in with the consortium, that's where you fish where the fish are. And if you are an intermediary and serving the healthcare industry, then working and collaborating with the healthcare consortium can be a good way to position yourself in a very valuable way. So there's 4 things I wanted to talk about. The last one really I thought of as logistics, but I thought gain was a better thing to spell than Gale. But these are all important things to be thinking about as you think about consortia. Governance, and if you think good governance isn't important, I would refer you as Exhibit A to the city where I live, Washington, D.C. Governance matters. Antitrust, intellectual property, and the nitty-gritty. Let's talk first about governance. And the governance things you want to be thinking about are how are we, for these consortia to work, you need good leadership. So who are the leaders going to be and how are decisions made? Is there a clear protocol or set of rules for how things are going to be decided? We've seen consortiums fail for lack of good governance. what ability to vote are you going to have? Are there different levels of participation? These are all things that you should be thinking about. Can you negotiate your level of participation? Who votes on what projects we're going to do? So just a few points there on governance. Talking about antitrust just a little bit. So antitrust laws are enforced by the Department of Justice and the Federal Trade Commission. Historically, whenever you have a situation where competitors are going to be in the same room talking, you have a risk of antitrust problems, including potentially the type of problems that send people to jail. And no matter how profitable your business is, it's much less enjoyable from jail. So what is, the antitrust laws are basically designed to promote competition. And what is competition? I think, obviously, we think of it as keeping prices low, but it's also about keeping output high. It's about keeping innovation high. It's about keeping output varied and providing consumer choice. It really is about the full consumer experience. There are sort of two, broadly speaking, types of antitrust problems. What we call per se problems, which is stuff that's just so bad, you just can't do it. So that's any collusion, any agreement to limit any of those basic competition factors, production, output, variety, price. That's a no-no, that's not acceptable. As well, any bid rigging and any division of territories. And then, if you're not in that realm, and I think most responsible consortia aren't, you fall under something called a rule of reason. And what that rule does is it really looks at the pro-competitive effects of a consortia, the anti-competitive effects, and whether there is a better means, an alternative means to get there. So, if you look at a consortia that, for example, is about food safety, you might say, okay, well, in a lot of ways, this looks very pro-competitive, right? It's going to cost consumers less to have safer food, and we're going to innovate around that. These are all things that are going to count on the plus side of the ledger. Then you might say, is there another way to get there? Is there a less, and then you'd also look at any negative effects that you might have. Are people being excluded? Is there going to be pressure to drive up prices? You'd weigh all those things in kind of a balancing test. As a practical matter, one thing you want to avoid almost as much, because of my friends on the plaintiff side who like to sue, I'm really on the defense side, is not just whether you're going to violate antitrust stuff, but whether you're going to be accused of it, because you don't want to be sued, and you don't want to have to pay money to make a suit go away. And therefore, you want a few ground rules when you're sitting down with your consortium. You want to have an agenda. You want to write that agenda down. You want to stick to that agenda. You want to make sure that you're not discussing things that you don't need to discuss with regard to the project you're working on. In particular, if you don't want to be popped, P-O-P, by the DOJ, don't discuss prices of things, don't discuss your output, and don't discuss your levels of production and your plans for the future. I'm sorry, the third P is plans for the future in terms of your business plans. More or less, any sensitive, competitive information, don't share without talking to a lawyer first. And in fact, I think it's a good idea to have some rules of the road, to read them at the beginning of meetings of consortia, to take careful notes, and possibly even to have a lawyer in the room. I don't often recommend having a lawyer in the room. It doesn't usually improve things. In this limited context, I think it makes sense. Intellectual property. You can have a lot of heartache down the road if you are not clear on your intellectual property. There's a couple things to think about in joining a consortia. One, what am I going to contribute in terms of my existing intellectual property? And if I do, how is it protected? Generally speaking, I think a common way to solve this is to sort of give a license, a worldwide, considered paid up, non-delegable license to use your IP in conjunction with the project, but you want to specify that. And then the second piece is, okay, we're going to be creating new IP if it goes well, in many instances. Who gets that IP? It is often cleanest and neatest if there's one owner, but of course, then you want to share. And once again, I go back to the idea of you can then have, for example, the consortia can own the IP, but they can grant everyone who worked on the project a license, and maybe people who didn't work on the project might get a license, but it might be more limited. So that's something you really want to just think about in advance. You don't want any surprises there. And the last thing, in terms of some of what I would call the nitty-gritty, actual project plans with deadlines and responsibility as to who's going to do what. I cannot tell you the number of times that mission creep has driven crazy the best intentions, the people who join consortiums with the best of intentions, and thought, not I'm going to be a free rider, but I know what my work is, it's going to be X, and particularly if the money, there's different ways to do the money, and it's important to think about that. One way is everyone pays dues, another way is everyone carries their burden on their share of the project. If you're doing some form of the latter, everyone's carrying their own burden, mission creep can really drive you crazy. So you want to know very clearly what it is that you're committing to do on this project. A lot of basic things. Who's going to do the press releases? Is it the consortium or is it you? And does it have to be agreed upon? Potentially a governance point. What are the duties of confidentiality? What happens if someone drops out? So all sorts of little logistical things have to be thought through. But the most important under this I want to think about is just the project plan. I think I've spoken for a while, and I want to make sure that you hear from Dave, because Dave is the man. Dave knows what the SEC is thinking, because he is the SEC. So, all you.
Right. Well, part of that is probably true. I appreciate it. Thank you very much, Cesare. Thanks very much, McCombs. Thank you all very much for attending today. I think it's been a fantastic day, and I really appreciate you all being patient and staying around through the end of the day to hear securities litigation, securities lawyer talk. It's nobody's highlight, but I appreciate you guys hanging in. And towards that end, they make me read this. The Securities and Exchange Commission, as a matter of policy, disclaims responsibility for any private publication or statement by any of its employees, especially me. Views expressed herein are those of myself and do not necessarily reflect the views of the Commission or other members of the staff of the Commission. So, with that out of the way, thank you. Interpretive reading is one of my strengths. So I'm happy to be here today. I think it's important for the SEC to be out at these types of events and talking to the Bitcoin and the cryptocurrency and crypto asset community. We want to be helpful. We want to try and guide the market in the direction that we think it's most appropriate to go, and we want to hear other voices to make sure that our thinking is valid and is consistent with good governments and good regulation. So as a matter of background, the SEC is a civil regulator. So no guns, no handcuffs, no arrests. Occasional sternly worded letters. That happens. But we're not criminal law enforcement. We do get subpoena authority in appropriate situations. We can compel you to come in and talk to us if there's need to do so, though typically we start more informally and just come in and ask for information. And your cooperation, if it comes up, is much appreciated. SEC has been looking at distributed ledger technology since long before I arrived at the Commission in 2015. A little bit about my background. I was a litigator at a big firm in Los Angeles for a number of years, and then left to start my own private investigation business, where I worked for about 10 or 11 years, and then started at the SEC in 2015. It's a little unusual for an SEC enforcement attorney to have an entrepreneurial background or be a former private investigator. I find it helpful. I think that kind of perspective is useful, particularly in this space where, frequently I'm dealing with either small business people or aspiring small business people, and being able to think a little bit about it from the other side of the table is helpful for everybody. The SEC has been messaging in this space very publicly since the summer of 2017, when we released what we call the Dow report, or a 21A report. I don't know how many of you are familiar with it. If you haven't read it, I would suggest you do read it. It's not that long. It's very helpful, I think, as far as giving you some insights into the way we view the world and what we think of as securities and why we think that some crypto assets are securities. And I'll explain why I say crypto assets, not cryptocurrencies, in a minute. But basically, Congress has not written any new rules regarding our regulatory authority over cryptocurrencies. So we are left working as regulators and enforcement attorneys with the same rules that have always been in place, and we regulate by analogy. We look at things that have come before and say, how is this similar? How is this different? How should we approach it? And the 21A report regarded the DAO, the Decentralized Autonomous Organization. We did not choose to take an enforcement action there for a number of reasons, one of which was the Ethereum fork pretty much replaced almost all of the losses. So there wasn't really a lot of money lost or a lot of reason to bring the hammer down on anybody. And also because we hadn't really been out publicly telling the market, here's where the red lines are. And it's not our goal to surprise anybody or to lay secret traps. Like, the goal is to try and, as a regulator, let you know where we think the lines are, and once you know, if you choose to cross those lines, then there may be more of a problem. So for a number of reasons, we did not actually bring an enforcement action, but we released this report, which is extremely uncommon. We hadn't released a 21A report for, I think, 3 or 4 years. Typically, if we choose not to bring an enforcement action, we just quietly close up shop and move on. But here we wanted to tell the public, we're not bringing one, but we could, and here's our thinking. And there, we reference back to a Supreme Court case from the 1940s in one of the least technologically interesting areas possible in Orange Grove. In that case, an investor sent money to somebody who was going to run an orange grove for them. They were going to have a piece of this orange grove. The person running it is going to grow the trees, harvest the oranges, sell them at market. All the investor does is send money and wait for the harvest money to come in, and they'll get their cut. And the SEC has jurisdiction over securities, but also over investment contracts. And so the issue there was, is this relationship regarding this orange grove a security, like a share of Apple stock? It's not. But is it an investment contract that would give us jurisdiction to regulate? And the court said, yes, it was. And the analysis is pretty simple. It's an investment of money with the expectation of profits based on the efforts of a third party. There have been some permutations, there have been some changes that are court or circuit specific in the many years since then, but that basic 3-part analysis is still very helpful. And we applied that same thinking in the Dow report, where there was investment of Ether. There have been other cases where an investment of Bitcoin, although no one says Bitcoin is necessarily money, the Howey test has been interpreted to say it's an exchange of money or exchange of value. So it doesn't have to be dollars. If you're giving up Ether, you're giving up Bitcoin, you're giving up something else of value, even sometimes your personal information or other things like that. If you're giving up something of value, that's enough to satisfy the first part. With the expectation of profits. The Dow was all about expectation of profits. It's everybody pooling their resources, converting Ether to Dow tokens, using Dow tokens to try and put money towards future investments. That was the goal of it. So 1 and 2 were pretty simple. The issue really there was the third prong, based on the efforts of a third party. The whole idea of the Dow as advertised was it's decentralized. This is going to be a corporation without management, no officers, no directors. It's going to be democratized. But we looked a little more deeply than that, and that's common for the way the SEC approaches these things. It's not so important to us what you call something. What's important to us is the substance behind it. And there was a group of kind of super users or curators who would decide what types of investments could actually even be put forward for a vote. And they played a very important role, as well as there were a group of promoters who actually programmed the smart contract or not so smart contract behind the Dow, and went out on YouTube and went out other places and tried to attract investment and tried to attract attention. And it was those people's efforts, the super curators and the promoters, who we looked at and said, yes, there's a third party who's making an effort. And people, when they're investing their money with an expectation of profits, it's based on the efforts of these third parties. How he is satisfied, that's an investment contract. That gets us in the door to court, if we so choose, to then be able to say regulate. And we are a disclosure-focused organization. Our goal is that if you're going to be taking other people's money for an ICO or any other type of capital-raising venture, that you provide them adequate disclosures about the risks involved, about who you are and your background, who your attorneys are, your auditors. Give them some significant level of risk disclosure so they can make a knowing bet, knowing decision as to whether or not to put their money towards your project. And the way we typically do that is by having issuers of securities, issuers of investment contracts register with us. And the last panel, I think, did a very good job explaining some of the complexities that go into it. And I'm an enforcement guy. I'm not a policy guy. I'm not a corporation finance guy. So I'm not the best person to speak to as to the different exemptions that you might qualify for if you're only selling to small groups or you're only selling to accredited investors. There are such exemptions. If you're curious about those, please contact me after this, either directly here or send me an email. My email is my last name, first initial, @sec.gov. So hirschd@sec.gov. And if I can't answer your question, I'll try and put you in touch with somebody who can. But fundamentally, the idea is if you're going to be raising money, then you need to either register with us or qualify for an exemption. I think that's, I don't want to use up all our Q&A time kind of giving you background, but this is kind of the framework and the foundation. And unless we have jurisdiction, we don't get involved. I know the one question that seemed like was echoing from the last panel that I wanted to quickly address is Bitcoin a cryptocurrency or a security? And that goes back to the distinction I was trying to draw between cryptocurrencies and crypto assets. So Bitcoin, I think if you run that same Howey analysis, and this is unfortunately the way we have to do everything, it's all facts and circumstances. It's all look at the particular thing we're talking about and see, does it fall, is it either a security clearly, or does it fall within the Howey test? So we can't just say every ICO is a security. We have to look at each one individually and look at its characteristics and see how does it fall within this particular kind of range of thought, this particular Howey analysis. So Bitcoin, we've never gone out and said we regulate Bitcoin or that Bitcoin is a security or that Bitcoin is an investment contract. We've never said we absolutely will never do that, but I think based on where we've been focusing our attention, you can draw some important distinction and draw some important ideas. And I think if, I can't speak for the agency clearly as I read to you at the start of this, but I think it would be difficult to try and explain how you match up the third aspect of the Howey test, what the efforts of a third party are in Bitcoin, at least as it exists today. And if there's no efforts of a third party, then it's less likely to be an investment contract or a security, and it's more likely to be a cryptocurrency, just a pure exchange of value. I think for some of the ICOs, and we've been pretty active recently as an agency bringing enforcement actions against both fraudulent ICOs and, in the Munchie case, ICOs that failed to register. And all of this information is available on investors.gov. We've got a big splash page specifically devoted to crypto assets. The chairman's been out speaking about this quite a bit. It's all helpful information. If you're curious, it's a wealth of information. That's probably where I would start. But I think the focus there has been on crypto assets, on things that are using cryptography as a tool for raising money. And that's not necessarily just pure exchange of value like dollars or gold or even potentially Bitcoin. It's more things that are, I want to try and fund the business that I will one day build, but I want to raise the money today, and I'm going to use a token to do it.
Right.
Go ahead.
I was going to say, now, in contrast to the SEC, the commodities regulator, the CFTC, has been very clear. In their view, Bitcoin is a commodity. They've said that, in their view, all virtual currencies are commodities. Query whether or not they're right about that. They're definitely right for Bitcoin. The way commodities were defined back in the day, so if you remember your Trading Places, which was sort of one of the early commodities movies, which I didn't follow at the time, but going back at it, I definitely don't follow it now. There's a list of what's a commodity, and it's frozen concentrated orange juice is on that list, and then there's a catch-all at the end of that list of about 15 different things, and it says any good, basically, in which there's a futures market. So for Bitcoin, there's a futures market. So Bitcoin is clearly a commodity. Other tokens where there's not a futures market, I think the CFTC would tell you we've got jurisdiction anyway, and that's sort of yet to be tested. But it's just to highlight the difference with regard to Bitcoin as compared to the SEC position.
And I recognize that's confusing. It's not always clear where our jurisdiction starts or ends, and another agency's jurisdiction starts or ends, and that's typically a bug, I would say, but it's sometimes a feature. Like, for instance, in the United States, there is no universal regulator. So no one can just come out one day and say, Bitcoin, no. ICOs, no. Like, we're stuck doing a facts and circumstances analysis and looking at each one on its individual merits. And I think that provides a certain degree of robustness to the market and a certain degree of protection for the market, although there are moments where you're scratching your head and figuring out which regulator do I need to satisfy here.
So the answer is, if you're just trying to ICO, you're not going to be affected by the CFTC unless you issue a virtual currency and you commit fraud. So the CFTC's fraud jurisdiction kicks in just by virtue of being a commodity, and that's really where they've tried to assert it. For their full regulatory jurisdiction to kick in and registration requirements to start to happen, that will happen when if there start to be futures or derivatives or swaps or that type of product on top of a commodity. So if you have the fortune that your coin is so popular like Bitcoin that it spawns a futures market, then the CFTC can get involved in a full way. You know, that's an interesting question. If it becomes a commodity and you are continuing to what's that? Release more of it. You know what? I don't know. I have to think that one through. That's a good question.
Yes.
So one of the things I'm very interested in watching is out in San Francisco, a number of the people spending $500,000, $750,000 for that they sell nothing to, and have other jurisdictions or Japan, other markets that are opening themselves up to what is a new form of security in many ways. And I'd love to get your thoughts on, is the SEC going to issue more clear guidance, or is it simply, or are we going to be stuck in a situation where U.S. individuals are excluded?
It's a good question and a fair question, and one I get quite a bit. And so one of the things I think that, one of the ways that I view this, the SEC is a three-part mission. The three parts are often in concert, but not always. So we protect investors, we ensure fair and efficient markets, we facilitate capital formation. Most of the time, those things all work together. Sometimes in the ICO market, there's some tension between those. So I could envision a situation where we are great at facilitating capital formation, but we're doing a terrible job protecting investors, and vice versa. And we're very conscious of that as an agency. The chairman's very conscious of it. Our goal is not to push new business offshore or deny Americans opportunities to either invest in new industries or to see those industries flourish here. That's definitely antithetical to what we're about. I guess one response I would say is, if you're spending that much money to make sure you exclude all Americans, should probably look into how much would it actually cost just to be compliant. Like, it's not necessarily that expensive to follow the rules. It might be a little slower, but there are opportunities to follow the rules, raise money here, and sell to Americans, and we're a great market. I mean, you're making a decision when you do that.
The issue from the people here, they don't want, while Munchies was an egregious case, they don't want halfway through an ICO process told, sorry, you're done, give it all back, shut it down.
So I don't know how many of you are familiar with Munchie, but Munchie was a case that was a company that was trying to build its own ecosystem. It was an app, and it hadn't really necessarily gathered a lot of traction. And the idea was restaurant reviews, but also being able to give tips at restaurants, be paid for writing reviews, and the token was going to be sort of the utility of that ecosystem, which did not yet quite exist. But they didn't register with us, and they did some other things they probably shouldn't have, including saying that they had performed this Howey analysis and they weren't a security. And so an attorney from the SEC contacted them and said, I'd love to see this Howey analysis. That sounds great. They're like, well, maybe analysis is a strong word. They hadn't really done it. They'd been promising returns on investment. That's generally considered a no-no if you really want to claim you're not an investment. And we got to them before they'd actually issued the token, and so it's a lot easier for us to resolve things quickly if that hasn't happened yet. Once the token's out in the wild, it becomes much more complex for us, because if there's money to pay those people back, who do you pay? The person who initially bought the token, the person who bought the token from that person? Like, it's a math problem and a morality or ethics problem that's a little bit difficult. We haven't necessarily parsed all the way through. There we got in before they issued it, and they voluntarily shut it down. They said, we're going to give all the money back. We didn't really mean to break the rules, and we didn't bring a major enforcement action against them. It was a cease and desist, basically. Just don't do this anymore. And I'd contrast that with some of the fraud ICOs where we have been active, and people claim to have raised significantly more money than they actually raised, claim to have team members that didn't actually exist, claim to have blockchain or features or attributes they didn't really have. We've been significantly more aggressive in trying to shut those folks down. I mean, fraud has our attention. We're resource constrained like all federal agencies. We're doing our best to try and both bring actions where appropriate, but also message the market so that folks can get a sense of where it's safe to travel and where they should be on shaky ground. Go ahead.
I've got kind of a specific question. So I'm advising a couple of clients right now that have purchased, and they are making an exemption on the advisor act as a private fund. But with that, they have to meet certain requirements. They have to park all of their crypto with a qualified custodian. And that doesn't really yet. So it's hard for them, if not impossible, to apply, especially with amount and variety of tokens. And my question, so my general question is this: how compliant do we have? Because right now, that doesn't that custodian doesn't. So try maybe I don't know if there's like a effort stand like that, but.
I'm going to let Mira handle that one. No, I'm kidding. Probably not the best. Again, I'm on the enforcement side and not on the corporation finance or investment advisor side. But shoot me an email. I'll be happy to try and direct your question to the right person. I understand what you're saying. It's something that we are thinking about, something we're certainly aware of. But A, I can't give you an answer in a hypothetical, and B, I probably wouldn't be the right person to give you that answer anyway.
Did you have any no action letters in this area?
I'm sorry, what?
Did you issue any no action letters in this area?
We issued any no action letters. I don't think certainly none that are, I don't think any that are public that I'm aware of. Not yet. We're still early days. I don't have exposure, and if I did, I wouldn't be able to comment. That until there's a very formal process through which things get publicized, which is part of the reason I don't have any slides here today. It is and I think this is appropriate. I'm not complaining. We are a very deliberative agency. We do not want somebody like me who's just sitting on the front lines to make policy for the entire agency. And all of our different divisions and offices have their own considerations, and they see their aspects of the securities and investment world much better than I can. And so whenever we do anything, everybody gets a chance to weigh in and speak to it before it ever goes out to the public. Sure. So I will divorce any answer from any specific entity, because I can't talk about any individual company or any individual. But I would just go back to the extent that what you're talking about is a token that is only going to be used within a closed ecosystem, and there's no profit motive, and there's no open trading, and none of the other things that make it look like an investment. That seems safer than something where you're going to give everybody who sends you money today instant liquidity by putting it on an exchange that you're not particularly monitoring or have any control over. The more you make it look like, and this is one of the peculiar areas of securities law. Typically, what we care about is what's in the mind of the person who's doing the thing. So we normally care if you're a CEO of a company and you're going out to the public and telling them things, we care what's in the CEO's mind. Does he know what he's saying is not true? For the Howey analysis, it's a bilateral analysis. So we care not only what the promoter thinks he's doing, but also the expectations of the person buying it. It's the expectations of profit that matters. And so you have to look at it not just from the person who's building the system, but the person who's actually sending the money in, the investor. That's not super typical, but it's kind of an important and unusual aspect of that particular way of seeing the world. I don't know that that has been formally decided either by the SEC or by a court. There's been an analogous series of case laws involving a private litigation called Morrison that specifically addressed territorial application of securities laws. And basically, if it's a foreign seller to a foreign investor, there's nothing necessarily in the code that gives us the authority to get involved. There was a fix to that under Dodd-Frank. So if there's fraud involved, then maybe we do have authority. I don't know that it's necessarily been extrapolated out, but typically, if there is a investment and either a U.S. seller or a U.S. buyer, then courts have said SEC has authority to be involved in that.
The antitrust, I asked this question of
Yeah.
Frank Ennis this morning.
Yeah.
What happens when you have Nestle, Cargill, Tyson all coming together? Say, okay, we are a consortium. We're coming up with the blockchain standard.
Yeah.
And the consortium is not imposing a cost, but in order to become compliant with the standard, you need to buy certain electronics, you need to install certain software, everything else. Is that likely something, that's the totality of circumstances, not an easy, like, where would you say something like that would fall?
Right. So this is not definitive, and I'd have to, sit down and work with it. But my initial reaction is it's probably going to be okay. That is on the anti-competitive side of the ledger, right? You're imposing a burden on sort of everyone in the downstream market, or to
if you wish to sell to us, you need to
sorry, everyone in the upstream market, which if you have Walmart and Kroger, and I mean that's going to have. There's certainly no doubt that has market power. It's not going to fall into such a low amount of the market that it kind of escapes notice for that reason. So that is on the anti-competitive side of the ledger with regard to people. I don't know that it's such a high cost, and I don't know. I mean, so in terms of what you're trying to achieve, is one thing you're going to look at is there a less is there an alternate way that would be less restrictive? And if what you really are trying to do is get everyone on the same page to have clarity about what where the food is coming from, I'm not sure there's going to be a less restrictive way to do it. And then you're just going to have to consider whatever the pro-competitive effects are. We're fostering innovation, we're getting it cheaper to the ultimate consumer, things like that. And so at the end of the day, I think that their lawyers are probably telling them that they're okay.
Okay.
Sure.
Yes.
I think I have not seen enough of them to be able to classify them as a universe, but any individual one that I had to look at would again be just under that same basic facts and circumstances, where does this look like an investment contract? Is there a third party who's going to be doing the work that will make the investor more money potentially? Is that why the investor is giving them money? Does that seem like what is being offered? So, and I've heard other, like, token generating event. I mean, they mess up the acronyms a bunch, but if you're not changing the underlying activity, then it doesn't necessarily change our analysis.
And your chairman has said that while he could imagine a situation in which a token of some sort is offered and it's not a security, he's yet to see one.
He has said that.
Yeah. So.
Can you add a little bit? In the previous panel, one of the guys said, we're just giving the tokens away. Does that help? Do you want to talk about free tokens?
So we have not taken an official position as to airdrops, as far as I know. That's kind of the term I've read for it. I'm sure there's other terms for it, but basically just going to seed it out. And I understand the thinking behind it. I mean, one of the things that tokens can be good for is generating the network effects necessary to actually make your ecosystem run. Like, that makes sense. I get that. There isn't a ton of law on that area, so I can't predict how that would go. It wouldn't be appropriate for me to do so. I would direct your attention in the late, I think, 99, there were 4 or 5 settled actions the SEC brought against basically stock promoters who were giving away stock in exchange for people giving them either their personal information so that they could market other stock offerings to them, or giving them other things. The SEC took the position that those were things of value that were being given by the investors in exchange for this free stock, which therefore wasn't free, now was an exchange of value, and brought registration violation cases against those people and settled against those people. There hasn't been any case brought specifically as to an airdrop, and so I don't know, without a court decision or a clear, regulatory action otherwise, it's not necessarily clear, but, previous settlements in the absence of those other things can be helpful as context. I think that's probably a safe way to approach it. I mean, again, there's no, unfortunately for me, as much as for all of you, there's no set box. If you fit within this box, you're good. If you're outside this box, you got to check your bag. We don't have that kind of framework, unfortunately. So, but yes, I mean, if the idea is, if in explaining to your 5-year-old, you explain what you're doing, and you're like, would you want to be a part of this? And he says, yes. You say, why? It's like, well, because I'll make more money. Then yeah, I think at that point, you probably should come talk to us. Unfortunately, not even a bottle of water. It's weird. People come and talk to us. I'll have a day where we're talking to them under oath. We can't hand them a bottle of water, which seems unfair, but so as far as giving you things, but we do welcome cooperation. We are very much focused on trying to help people do things the right way, and it's not our goal that have somebody come in, lay it on the line, and be like, aha, never should have done that. Now we're throwing a book at you. I mean, we can no more. We can't give you a free pass because you are good enough to come in and confess. But we'll definitely take it into consideration that you're trying to do the right thing, and we're going to take that as a sign that you're at least attempting to be cooperative and trying to do things the right way. And we value that. I mean, we have. For registration, not so much. For fraud, we've got many different levels, or at least a few different levels that we can charge depending on, as much as anything, how cooperative the other side is being as far as trying to come clean and do the right thing. So we have similar rules for exchanges and brokers and dealers that we have for issuers. So people who are issuing coins or issuers, they have to register under certain code sections, Section 5. If you're a broker or a dealer, you have to register under Section 15A. If you're an exchange, you have to register under a different section. And if you don't register with us and you're a securities exchange, as opposed to a pure cryptocurrency exchange, and I think that is why you'll see some exchanges only handle Bitcoin or only handle Bitcoin and Ethereum, is that the more you get into something that could be considered a crypto asset and less a cryptocurrency, the more they're concerned about possibly having to either register with us or incurring liability for failing to register with us. And if you look at the trading activity on some of the smaller exchanges and the unregistered exchanges, if you look at it carefully, it's scary to me as an individual. I can't say for anybody else. And I don't own or trade cryptocurrencies. We've recently been granted authority that if we work these cases in certain circumstances, you can own certain ones of them. I just don't, because I never want anyone to think that anything I'm doing is for my own personal gain as it relates to any of these things. I'm very clear about those things. But I watch them. I mean, I'm in this space. I need to know about them. And some of the exchanges just seem like the volume is so thin on them that they are susceptible to manipulation in a way that the big national exchanges aren't. And so, should they be registering with us? Probably. Is that something we're paying attention to?
You had the question over there, yes.
Yeah, I do. So buyers have liability if they were to nobody to the U.S. In the U.S. But what if I figure out a way to get into something clear as a security but maybe issue my network?
Yeah. So if you look at where we've both been speaking and where we've been bringing enforcement actions as indicative of where our priorities are, you won't see any cases brought against buyers. And it's really our focus to protect investors. The one distinction I would draw is if you're such a big buyer that you could be seen as either a promoter or somebody so closely aligned with the project as to be, supporting it in a material way, that may be a somewhat different analysis for us. But if all you are is just one of 10,000 people buying a particular token, that isn't someplace we've devoted any resources, as far as I know.
Last question. So thank you so much, both Alex and Dave.
Thank you. You had a question. This.